Hello, welcome to Accounting Hub. I'm Professor George Scarpin, PhD in accounting, and our topic today is another video about financial statement analysis. We are talking today about profitability ratios. We have four videos about financial statement analysis. The first one, vertical and horizontal analysis. The second one, liquidity ratios. The third one, solvency ratio, and this one, profitability ratios. All of the four videos, they are in our video description. And by the way, subscribe our channel. You will be the first one to know when a new video arrives. Okay? So profitability ratios. We have some ratios here. The first one, gross profit ratio. Gross profit divided by net sales. What is the purpose here? Gross profit. What is gross profit? Net sales less cost of sales or cost of goods sold is gross profit. So, gross profit is our sales after our production cost. So, okay, how much is this earnings that we have? How much in percentage? Then we have three videos for net income. Uh, Return on assets. Net income divided by average total assets. This is very important when we are comparing more than one company. We have two different sizes company. We have a local coffee shop and we have, for instance, Starbucks. Of course, Starbucks will have a much higher net income than the local coffee shop. However, Starbucks is much larger than the local coffee shop. And how do we know the size of the company or how do we analyze it? Based on total assets. And then when we compare net income divided by total asset, we put these two companies in the same scale here. So we are able to analyze it. Profit margin, the same as gross profit ratio. However, instead of gross profit, net income divided by net sales. We can also work with operating margin, that is operating income divided by net sales, but not so often. We can work with a lot of margins here. We divide what we want, net income, operating income, EBITDA, and so on, divided by net sales. Asset turnover, net sales divided by average total assets. If we go back to financial accounting, what is asset? Asset should provide future economic benefits. How do we know the future economic benefits? By net sales. So, how much sales this asset is able to provide? Okay. Return on equity, net income divided by average stockholders' equity, is the same as asset. However, we are not worried about the size anymore. We are worried about investors and how much money these investors is earning. And then we can compare it with a low risk rate for any financial instruments that we have in every country. They have their own. And the last one, price earnings ratio, stock price divided by earnings per share. And here we have a problem. We don't have stock prices in our financial statements. And earnings per share, we have it. So let's go to our Excel file. Coca-Cola is our company. A huge disclaimer here. We are not working with any classified information. It is all public and they are on this link here. If you want to check, it is in a form called 10K. You can copy and paste this link here or go to our video description and the link is over there. Okay, so let's go here. And let me open my my Google Chrome here a little, but okay. Let's work with the ratios first. And wow, it's here. Okay, we will need it later. Okay, Excel file. Let's do it. We have here 5 sheets. Income statement with income statement data and vertical and horizontal analysis. The second one, the balance sheet data and also vertical and horizontal analysis. So our video about vertical and horizontal analysis, the data are here. Then liquidity ratios, solvency ratios, and now profitability ratios. So all of our 4 videos, we work with the same Excel file. Okay? Gross profit ratio, gross profit divided by net sales. Income statement, income statement. So income statement here, gross profit divided by net sales. And these ratios here, they are in percentage. Uh, they are all in percentage, but asset turnover and price earnings ratio. Okay, so here our gross profit ratio is 60.75, 77. Sorry, so a little bit less than 40% is our cost of goods sold, and here we have the greater the better. And we cannot copy and paste this number here. It's the same one because here we have the vertical analysis. So we are not able to do that. So we need to do our formula again. So gross profit 2018 divided by net sales. So it's a little bit lower, so a little bit worse, but almost the same. Why don't we have 2017 here? Because, for instance, this ratio here, we need the average. When we need the average total asset is current year plus previous year divided by 2. So we work with 2017 only for this average. Okay? Return on asset, net income. Net income is income statement. Here, net income divided by average total asset. So average total asset is balance sheet. So we need a double parenthesis here. Double parenthesis here. Assets 2019 plus 2018. Close the first parenthesis divided by 2. And we have our return on asset also. Let's format here. Okay, everything here is percentage. 10%, nice number. Usually number above 5, we can consider it a good number. And by the way, it doesn't matter if you are in the US or abroad or in any other country. The ratios, they are globally used. So we have the same ratios here. 2018, let's check if the number is better or worse. Net income divided by double parenthesis, total asset 2018 plus total asset 2017 divided by 2 and 7.53. So all of our uh, ratios here, they are the greater, the better. Okay? So what do we have here? Our return on the gross profit ratio is a little bit lower. However, return on asset is much higher, almost 30% higher here. So very good number. Profit margin, net income divided by net sales. So net income divided by net sales or net revenue. There are some countries that they call it net revenue. Okay, it is the same. 23, very, very high. Wow, we cannot copy and paste. Very high profit margin here. So, okay, Coca-Cola a little bit lower here, but much higher profit margin. Usually for this kind of company, anything more than 10 is a very high number. So 23, almost 24 is a huge profit margin. Asset turnover. Oh, return on equity. We need a price earnings ratio. And asset turnover, net sales divided by average total assets. So looks like the return on assets. Net sales divided by double parentheses here. Total asset 2019, total asset 2018 divided by 2. Oh, there is a plus here. Okay, 0.43 is our asset turnover here. So 43%, almost 44. Nice number, but let's analyze it better if we have 2018. Divided by double parentheses here. Total asset 2018 plus total asset 2017 divided by 2. And we have here 40. So it is a good number because it is the same as our return asset, the same behavior here. So, okay, our return is increasing, our asset turnover is also increasing. So the behavior of revenue and income is the same, and that is good. It's not good to have a lower revenue but a higher income. Something with with extraordinary items happen. So maybe we have a huge gain, a huge temporary gain, and that is not so good. So these two ratios here, they should have the same behavior. And return on asset is the same with return on equity. It's the same as return on assets. Let's check if they have the same behavior here. Net income divided by average stockholders' equity. So net income, we are here. Net income divided by double parentheses. Total equity, 2019 plus 2018 divided by 2. And it's also parentheses. 49, huge, huge return on equity. However, this is huge because Coca-Cola, they repurchase a lot of their own stocks. So maybe their equity is artificially low. So that is a very good point. Financial statement analysis is not only looking at the ratios. We need to analyze the and some kind of holistic analysis here. We need to analyze the big picture. Okay. So return on asset on income again, net income divided by our equities. 2018, 2017 divided by 2. So 37 again increases a lot. So that is good. We have no uh, stock issuance here, so it is good. We have no extraordinary items here. And now we need stock price divided by earnings per share. Earnings per share, they are in the financial statements, in the income statement. Usually we have basic and diluted earnings per share. Usually they are almost the same. And the price earnings ratio or PE ratio will be the same or almost the same. So it doesn't matter. Usually we work with the basic EPS, beef excluding extraordinary items because we don't want the extraordinary items because they are only for one particular year. How do we know the stock price? Let's go to Google. Let me open this one, is better. The stock, so Coca-Cola stock price. Ask Google, and here we have it 47.20. So 47.20 divided by income statement, the basic earnings per share. So 22. So it is a P of 22. So our stock price is 22 times greater than our earnings per share. 2018, let's check on Google if we have the old number. Stock price on 2018. Coca-Cola stock historical prices. Let's see if we can check it. Uh, okay, frequency. We don't want daily. Okay. Okay, loading more data and okay. If frequency daily, monthly. So let's apply here. Let's check what we have. Okay, let's take the close number usually. Let's take, okay, our income statement is from December 2019. So let's take the number on December 2019, 58.4. So here, 58.4, 27. Let's check if we have the August. Oh, time periods. Start date. Oh, guys, we only need to check here, okay? Done. Apply. Okay, January 1st, 2019. Close is the here 48.13. Here plus 48.13 divided by earnings per share. Earnings per share here 151.31. So here, what do we have? It's very good if we can compare it. It means that comparing to 2018, the stock price is a little bit cheaper than 2018. So if we compare 2019, the stock price, the PE ratio is 27. So our stock price is 27 greater than our earnings per share. On 2018 is 31. So it is 31 times our earnings per share. So it is a little bit cheaper now. So here, the greater the number, the more expensive is our stock prices, or the more the market sees as a potential future earnings. So here we don't have the greater the better, the lower the better. We need to combine this analysis with other analysis. Okay, but so this one, stock price, we need to Google it, and it is not hard. And by the way, it's a free ad now. Yahoo Finance is one of the best way to find the stock prices for free. Okay, if you don't have any financial database such as Bloomberg, Thomson Reuters, CompuStat, and so on, uh, Yahoo Finance is a very good source of free stock market data. Okay, guys, so thank you so much. Subscribe our channel. You will be the first one to know when a new video arrives. Like our Facebook page, Accounting Hub by Dr. Scarpin. And like this video, please. If you have questions or comments, leave it here or email me at jscarpin@gmail.com. Have a very, very nice day and God bless you.